This is Gary Chan. I wanted to showcase a property that is multifamily because what you can do with this is you can rent one unit out and you can live in the other unit. So this one here is a property that just came out 2 hours ago, and it's in the Auburn Gresham neighborhood, 7829 South Union Avenue, listed for $249,000. It says it's 6-bedroom, 3-bathroom. When I look at this and this is multifamily, I'm thinking there's probably 3 bedrooms in one unit, 3 bedrooms in the other unit. One of them has 2 bathrooms, one of them has 1 bathroom. I'm not entirely sure because sometimes the numbers are all wonky, but that's my first impression. Okay, so I'm going to click through here. And when I first look at the picture here, I'm thinking, okay, it's in relatively good condition inside. Maybe it's been recently remodeled for resale. And not a whole lot of pictures, but kind of gives you a sense that it's pretty good condition inside. It's described as a beautiful multifamily building, great block, and great floor plan. Each unit has 3 bedrooms, 1 bathroom. Okay, so maybe the information up here is not correct. It could be 3-1 and 3-1. Maybe there's an extra bathroom in the basement level. Don't know. Newer finishes throughout building. This property is a very good deal. Will pass FHA VA. Conventional offers welcome. Seller has price building to move quickly. Okay. And it's listed as a multi-occupancy built in 1911, so it's obviously been remodeled since then. Forced air and gas heating. Cooling has no data. It'll be good to know if it has a cooling units. 6 bedrooms, 3 bathrooms, 2 full bathrooms, and 1 half bathroom. So I'm wondering where that extra half bathroom is. Basement is unfinished. Flooring is hardwood. Appliances including refrigerator. I'm wondering why it doesn't say stove. Usually you get the fridge and the stove. Garage is detached and there's 2 car spaces. So you've got 2 units, and then maybe each unit is sharing the garage and they get 1 parking space. That's something you got to think about. It's a little bit odd, but maybe if you lived in 1 unit, you would keep the garage for yourself and other people would park on the street. So you got to look at the street parking and make sure there's enough space there. Or if the street's really, really packed, because tenants may not like that. And it's a brick exterior, which is good. Taxes. I really like to know what about taxes. Now, Z estimate here says 105, but they're pricing this at 250, so it sounds like it's up on the high side. Although this has been remodeled and Auburn Gresham is on the rise, you are paying on the upside of things. I'm not too sure if Z-Estimate really calculates multifamily properties well. It may be comparing this to single-family residence properties. And in that case, then this whole calculation thing is kind of off. Imagine if this was a single-family home with 6 bedrooms and 3 bathrooms. Well, that's not a fair comparison. And you might need to get some extra comps. So we'll continue. And here's the other thing. I would consider comps comparable market analysis, meaning other properties with similar number of beds and baths and condition inside. But another big thing is I would think about the rental value. So are these numbers here? Let's say you do 5% down, or let's say you can do 3.5% down, okay? And that would put you at 50, no, that doesn't sound right. I don't think that updated. So that would be $8,715 down, a 30-year fixed rate mortgage at 3%. Your principal and interest payment would be $1,000 a month. Wow, that's really quite good. Your mortgage insurance $196, your property tax $444 per month, your home insurance $87. No HOA fees. So total of all this would put you at $1,743 per month. And if you rent out the other unit at $1,350 per month, what is that? Let's say $1,750 just to keep it simple, minus $1,350, your net cost would be $400 a month. Now, keep in mind that doesn't include your utilities, because they say here utilities not included. So factor in another, let's say, $250 a month just to make sure. What was it? 400 plus 250, 650. So you're in at about $650 a month. But even if you rented, you'd still have to pay some utilities, you know? So, another thing I want to talk about here is the whole Zillow prediction value. So this whole thing is expected to go up about 8 to 9% a year. What I want to talk about is the lifespan of your investment, okay? So if we go back to this graph here, and if you were to imagine having purchased this way back in 2012, what could you have paid for it? See this graph that's really like, not the dotted line one, but the one that's like zigzagging up and down? That one way back in 2012, you could have maybe purchased at $75,000. And now it's all the way up to like $250,000. It has gone through some remodeling, and typically a remodel cost could cost you $35,000 to $50,000. But if you were able to get it back in 2012 for, let's say, $75,000 and spend $50,000 to remodel it, you'd be at $125,000. And then you could sell it in today's market at $250,000, which would be double your return on investment over an 8-year time frame. Typically, professional investors are looking at 5-year time frames. And I mean, I couldn't say all professional investors, but let's just say there's a subset of professional investors out there, and what they're looking at is purchasing property and renting it out over a 5-year time frame. Let's say they bought it 2012. They'd be looking at selling it in, like, let's say 2017, increasing the rent over that time frame, and then reselling it to other investors at a certain cap rate. So let's say 7%. In 2012, the rental values might be lower. They would wait till, let's say back then it was $750 a month, and then they would raise the rent to $850 and $950 and $1050 and $1150, and then in 5 years later they would be charging, like, what was it, $750 plus $500. I mean, I'm just giving you the idea. It's not the exact numbers, but in the 5-year time frame they would increase the rents, and the value of the property would be based on the rents. So by the time they would sell the property, they would make well over 50% on the returns of just reselling it. They would also have collected rental income over the 5-year time frame. And they can also depreciate the property so that their profits on it are tax deductible. I don't know if that's the right word, deductions and whatnot, because I'm not a tax professional. But because of the depreciation on the property, they would pay very little to no taxes on the property. And then they could do a 1031 exchange the property into another property, and just keep flipping the money and the investments all the way back into the real estate investment. So just kind of giving you kind of what we call, like, just the concepts of how this overall investment plan might work. This, I think, might fall into the category of house hacking, that is living in the property and then renting out the other, part of the building. And this is a popular thing to do in the Chicagoland area. Although not everyone has an opportunity to do that because not every building is multifamily. You also, with this building, have less headache of remodeling. And I think for someone that is more on the newish side, I think that, and also if you're a full-time job, this is definitely a way to go, is just buying a building that's all ready to go. So, I guess that's it for now. Hope you guys have picked up a few tips from this one. And until next time, I'll talk to you later.